there. Good afternoon, and welcome everybody to our monthly webinar hosted by Elevate Wealth Advisory. I'm Deanne Rosso, President and CEO of Elevate Wealth, and we're thrilled that you've joined us today for our 2025 year-end review. So this is something that we do every year, or for the last few years that we've done, as a wrap-up to the year. 2025 was quite a year, so what are the things that happened? What are the things that may have impacted you, your investment strategies, your portfolios, your plans for the future? And what are the things we're looking forward to in 2026? So we're excited to be with you today. We have a wealth, no pun intended, of our team members with us today, as well as a couple of guests, speakers from our partner, Focus Partners Advisor Solutions. And so I'd like to take a moment to introduce Mike Osborne. Mike is Managing Director at Focus Partners Advisor Solutions, and Kevin Grogan, he is Chief Investment Officer of Systematic Strategies at Focus Partners Wealth. We thank you guys so much for joining us today, first of all. And secondly, we lean on Focus Partners Advisor Solutions all throughout the year to help us with our back office management of our client accounts and to provide us with lots of value-added tools that we then take and use in order to help our clients achieve their financial goals. So thank you guys so much for all that you do to support us all year round and for being with us today. And with that being, of course, absolutely. With that being said, Betsy is going to post the links to the bios because both Kevin and Mike are quite accomplished gentlemen, and we could spend half the webinar just talking about all the wonderful things that they've done and accomplished in their careers. But instead, I'd like to ask them, and I'll pitch it to Mike first. What is the most interesting or fun thing you've watched, read, or listened to in 2025?
So I went to Florida State. It was not watching Florida State football, I can tell you that. The first game was good, but no, I'd say I did read several really good books, but there was a show that I really enjoyed. I don't binge a lot of shows. I'm a little behind the curve, but there's a Netflix show called Department Q, and I thought it was terrific. It's filmed in Scotland, and it's about this kind of struggling detective and really a crazy case. It's probably not for everyone, but if you like kind of the whole detective and British shows, it kept me on edge, and I think I'd probably watch that within a week, 2 weeks. So it was a good one.
Okay, so not quite a binge, but close.
Yeah, yeah, pretty. For me, it was a binge.
Awesome. All right. So Department Q for Mike. And then Kevin, what have you watched, listened to, or read this year that was most interesting?
So I was going to go TV show as well. And my favorite show from the year was a show called Task. It was on HBO, starring Mark Ruffalo. It's essentially about a task force investigating some robberies and some drug activity and that sort of thing. It was really well done. It was done by the same showrunner who did Mayor of Easttown, if you'd watched that a few years back during the throes of the pandemic. But those were, yeah, that would be probably my favorite show from 2025.
Great. Okay, so neither of those shows I'd heard of. So I've got two new things to pick up and watch. So thank
There
you.
you go.
All right, so let's just launch right into the question and or the question and answer session, and we're going to take turns as team members going around and asking our questions, and we're going to start today with our founder, Chuck Vickery. So Chuck, take it away.
Kevin, Mike, good to see y'all again.
We
You know,
we
we
take a
started
break
the year
first from that.
visiting with
I
clients.
think that Kevin and Mike actually have a quick overview to give us real quick before we launch into
Oh,
that.
okay.
Yeah, thank you.
Post error. Go ahead, Kevin.
Sure thing. Although now everyone's on pins and needles waiting for what that question's going to be. But yeah, happy to kind of launch in with sort of some of the prepared content, and we'll get to the Q&A, here in whatever 15 minutes or so. But let me go ahead and share my screen. Give me a second. Okay. So this slide essentially summarizes market performance through the end of the third quarter. And the good news is, here so far in the fourth quarter, markets are also up so far here this quarter as well. So, it's always being the person presenting the investment returns when all the arrows are pointing upward like they are on this slide. So, Stocks and bonds both delivered really solid performance in the third quarter, and you can also see the trailing 12 months through the end of the third quarter there at the bottom of the slide. And so essentially, over the trailing 12 months, seeing results in the mid-teens for all regions. So whether it's US, developed ex-US, or emerging market stocks, all up really solidly over the trailing 12 months. And then bonds also up around 3% over the trailing 12 months. And so that, again, is a really good outcome so far here in 2025 and for the trailing 12 months. This next slide, I thought, is a good kind of illustration and reminder that bull markets don't die of old age, generally speaking, number one. And number two, when you do see a downturn, it tends not to last all that long. And so it's important to stay disciplined to your plan, even in the midst of a market pullback. And so I think as you think back to 2025, we saw the results on the prior slide of what markets did, but it's easy to forget just how scary it looked back in early April when the market was pulling back due to the tariff announcements being more severe or more aggressive than what was anticipated by markets. So at one point, the market had pulled back 20%, and that's sort of crazy to think about. Again, kind of thinking back to the trailing 12-month period being up 15, 16, 17%. And despite that, we had a 20% drawdown at one point in 2025. So again, kind of helps illustrate the importance of staying disciplined to your long-term plan, even in the face of market volatility. Another kind of related point that comes up as the market has hit new highs is now a good time to invest? Should I wait for the market to pull back before investing? And this can be somewhat counterintuitive, but the returns have actually been better if you were to choose to invest on a day that's an all-time high versus investing on any other day in the calendar. And so kind of the reason for that is that the market delivers positive returns on average. So it just tends to grind higher over time. So even if today is an all-time high, it's still a really good day to invest, even if the market is hitting an all-time high. Another question that's come up is are we in a bubble? And that a lot of comparisons have been made to the tech bubble back in the late 90s, early 2000s. And so there's obviously a lot of numbers on this slide. I won't go through all of them, but I think an important thing to remember is that the companies of today aren't nearly as highly levered as they were back in the late 1990s. And so while it's certainly true that prices are high now relative to history, there are some differences, again, specifically on the leverage point. And then the second point I'd make too is that the evidence on when valuations are high, it doesn't mean that the market is doomed to a crash. It could just mean that forward-looking returns might be a bit lower than what we had experienced historically. And so I think that's important to build into the planning that you're doing. But beyond that, I don't think it's useful as an indicator for trying to time the market or anything along those lines. Next slide has, again, a lot of data on it related to the economy. And I think the economy is in a pretty interesting spot right now in the sense that, depending upon how you want to look at it, there are different ways you could interpret it. So specifically, as you see on the slide, you can kind of see on the left-hand side showing GDP growth versus payroll growth, or how many new jobs are getting added. And so what we're seeing right now is that job growth is starting to slow. There was a jobs report that came out this morning that showed a continuation of this theme that's shown on the slide, that we're seeing job growth slowing, but while at the same time we're seeing economic growth actually start to accelerate. And that's not a normal state of affairs. Typically, when you see job growth starting to slow, that kind of coincides with economic growth slowing. And so there are a few different possible explanations for that. And I guess before I jump to that, one other thing I would highlight on the right-hand side of the slide is the unemployment rate. So this is showing as 4.3%. The report this morning came in at 4.6%. So you are, again, kind of seeing a continuation of that theme of labor markets starting to slow while economic growth remains pretty strong. So in terms of the potential reasons for that, and I think there are a few possibilities. It's likely a mix of all of these. Number one could be just a change in demographics. We could be seeing just more retirements and a smaller labor pool, and that could be why we're not seeing the economy add as many jobs as it did previously. Another popular explanation is just the slowdown in immigration combined with the increase in deportations. That could just mean fewer new workers are getting added to the economy. So that, again, could be a reason why we're seeing an economic slowdown. And then the third possibility could just be a series change or a change in productivity due to artificial intelligence or other technological developments. Could just mean that the economy just doesn't need as many jobs as it used to get the same economic growth that we saw previously. So all of these, I think, are possibilities, but it is kind of a difficult puzzle right now, and that kind of plays into the Federal Reserve policy that they're trying to sift through in terms of they, of course, have what's called a dual mandate, where they are trying to both achieve stable prices, which is defined as 2% long run inflation on the one hand, and on the other hand, they're trying to achieve full employment, which could be defined as trying to get as many people employed as possible without causing inflation to run hotter than 2%. And so they have sort of two goals that they are looking to achieve. And so on that inflation note, if you look at that core CPI number on this slide, which is CPI excluding the more volatile sectors of food and energy, that's run at north of 3% over the trailing 12 months, which is obviously a good bit away from their long run goal of 2%. And so they're sort of in a tough spot where they have been cutting interest rates this year. They've cut rates by about 0.75% over the course of the year because they are concerned about the labor side of that equation, that they are concerned that the labor market is starting to slow down. So they want to cut rates to try to stimulate the economy, but that doesn't come without risk. The risk that they're running is if they cut interest rates and not only does inflation not get back down to 2%, but they're running the risk that inflation could reignite and run even hotter than the 3% that it has been running over the trailing 12 months or so. And so in terms of what to expect for next year, the market is expecting another 0.5% of rate cuts over the course of 2026. If you look at what the committee is projecting, they're projecting just one cut next year. It'll be interesting to see sort of who is right, those who actually have control over the policy, or market participants who, again, think that we'll see 0.5% of rate cuts as opposed to the 0.25% of rate cuts that the committee is forecasting for next year. And this just shows kind of the history of sort of where we've come in terms of where we've come, and then the bars in teal are sort of where the committee is projecting that will be by year end next year and by year end 2027. So you can kind of see the history here where the Fed started raising rates in response to the inflation that we saw in 2021 and 2022. I think it's pretty much inarguable that they waited too long to raise rates in that environment, and it's still yet to be seen as to whether or not cutting rates now is the right decision or not. And I would say, if my humble opinion, I think it's a pretty difficult call right now, because you do again kind of see inflation north of target, which you don't want, but it's no doubt that the labor market is seemingly slowing a good bit. And so I do understand the impulse to cut rates to try to support the labor market. Again, we'll just have to see if inflation reignites coming out of this or not. And so that's what I had in terms of prepared comments. But yeah, now happy to open up for questions.
Okay, so now we'll take everyone off their pens and needles. Thank you, Kevin, for that great overview. And also for the audience, if you have any questions regarding Kevin's comments or any questions that might arise while our team members are asking questions, feel free to post those in the chat box, and Betsy's going to monitor that, and we will, should time allow, we will get to those at the end. So now I will pass the proverbial mic over to our founder, Chuck Vickery.
Thanks, Kevin. Great remarks. Earlier this year, we were telling everybody that the Tax Cut and Jobs Act is going to expire this year. And we're either going to get a new tax bill or we're going back to the 2017 tax code. And obviously in July, the one big beautiful bill passed. So, which is now the tax law of the land. Kevin, Mike, whichever one of y'all want to take this. What are the major parts of the one big beautiful bill that are going to apply to the average investor that we might serve?
Thanks, Chuck. Great question. I can take that one. Yeah, it was signed. Took a while to get through. I think it was actually signed on the 4th of July, and it is a big bill. I think it's 870 pages, so there's a lot to sift through, but there are several provisions that will apply to most of us. And as you mentioned, um, it made several of these provisions permanent tax provisions. But let me say, it's permanent until you get a new Congress and they make changes down the road. So anything that's permanent is only permanent until our government makes a change at some point. But a couple of the big points that I would mention. First of all, there are lower income tax rates across the board. The top tax bracket went from 39 to 37, and there's 7 brackets. They all went down a little bit. The next one is an increase of the standard deduction, and that went up to 31,500 if you're married filing jointly, and it's half of that, 15,750 for single filers. That was almost a double of the standard deduction. So a lot of us that maybe were itemizing in the past may just use that standard deduction going forward. The child tax credit went up, and that has gone up to 2,200 per child. That's a minor increase. I believe it was 2,000 in 2024. That will also be indexed for inflation. The personal exemption is gone, and there is a qualified business income deduction. That's not going to apply to as many of us, but there's a 20% deduction for pass-through business owners. So if you're a business owner, work with your CPA and possibly look into that. And then there's also some temporary new deductions. This one was big. This was in the news quite a bit. Tips and overtime pay. So there's a deduction of up to 25,000 for married filing jointly, and half of that 12,500 if you're single. There are phase outs depending on your income. So again, work with your Elevate team, work with your CPA. If you're receiving overtime or any kind of tips, there's a senior deduction. So anyone over 65, you can claim an additional 6,000 deduction. That's on top of the standard deduction. 6,000 if you're single, 12,000 if you are married filing jointly. And then a couple just to close out. There is a deduction if you purchase a new vehicle and it's assembled in the U.S. You can deduct up to 10,000 annually on the interest paid on the loan. Again, that's new vehicles only. And then rounding out a couple changes, most of you have probably heard of SALT tax. SALT tax just stands for state and local income tax. There was a 10,000 cap that has been increased pretty dramatically to 40,000. Again, there's some phase outs as your income goes up. This is temporary through 2029, at which point it will revert back to 10,000 if there's not an amendment to that clause. And then energy credits are going away. If you'll remember, there was an electric vehicle credit. I think that expired in September or October, so that one is gone. There is a residential energy improvement that is still in place. That is in place through the end of the year. So if you're thinking about a new water heater or an efficient HVAC unit, there's still little time, but you're running out of time. If you're going to make that purchase, and you need to make that purchase, it would make sense to try to make that purchase before year end. So that's a high level overview of the big beautiful bill, Chuck.
Awesome. Thank you, Mike. Lots of things included in the one big beautiful bill that could impact you tax wise. And sometimes we get the question, why are you guys focused on taxes? And it's because taxes play such a huge part in your overall income plan, whether you are in your accumulation phase and you're still in your working years and earning, or in retirement when we flip that around into distributions. So we at Elevate, we focus a lot on taxes and tax planning and how can we minimize those taxes for you. And One Big Beautiful Bill Act had a lot of tax implications. And speaking of another act that rolled out a few years ago, not to forget about it, but Secure Act 2.0, that became effective a couple of years ago, but it was a 3 or 4 year rollout of lots of different features. So for either of you, what items from Secure Act 2.0 became effective in 2025, and then what rolls out in 2026?
So I'll take that one also, Deanne. The Secure Act, a lot of what the Secure Act is trying to do when it was put in place is to increase retirement plan savings. So a lot of the provisions that I'll talk about, and there's not as many as the big beautiful bill, but most of what I'll talk about would employ or would apply to someone who is working for an employer and that employer has a retirement plan that you can invest in. The first one is that if you start a new job, there is now a mandatory automatic enrollment. So your employer is going to automatically sign you up for the plan, and they have to sign you up somewhere between 3 and 10% of your annual income. You could go in and stop that. I wouldn't recommend that. It's critical to invest in that plan, and certainly if your employer has a match, that's a wonderful thing. But it is now mandatory when you start a job. The second thing I'll mention is there's expanded eligibility for part-time workers. Part-time workers, if you work 500 hours and you've been at the company for 2 years, you are now eligible to be in the plan. And that used to be 3 years. So it's gone down from 3 years to 2 years. This next one is interesting to me. There's an expanded catch-up contribution. But for some reason, it's for 4 years. So if you're age 60 to 63, pay attention to me and probably reach out to your advisor. But if you're 64 or 59, it doesn't apply to you. I have no idea why they picked those 4 years. But what that means, if you're 60 to 63, there's already an increased catch-up if you're 50 or older. And this just increases that number if you're still employed, and again, if you're age 60 to 63. Rolling out in 2026, a couple of changes I'll mention here. The catch-up contribution I mentioned for age 50 and older. There's going to be a change going into place in 2026 for high income earners. So if you make more than 145,000 and you're 50 or older, any catch-up contributions have to go in as an after-tax Roth contribution. If your plan does not have a Roth, you cannot make any catch-up contributions. More and more plans do have Roth options now today, but not all do. So again, this is one that I would work with your benefits team and your advisor at Elevate. And then the last one I'll mention for 2026, there is a penalty-free withdrawal option for long-term care plans. So if you have a long-term care plan, you can take a penalty-free withdrawal up to $2,500 per year. And again, that is going to be new for 2026.
So again, lots of little things. When we talk about the Secure Act 2.0, we always talk about 100 little things that rolled out and that are becoming effective over a few years. So some things this year and some things next year. And like Mike said, a lot of things that may or may not apply to you depending on your age. So if you have questions about that, reach out and ask us, and we can certainly guide you in that way. Now shifting over to market and environment conditions, Clark Holt, you're up next.
Thanks, Dan. Thanks, Kevin and Mike, for being with us. So, as you know, the sequence of returns risk is the risk that the timing and the order of our investment returns, not just our average return, can negatively affect our portfolio, especially when there's money being withdrawn. So my question is, with today's ongoing high inflation and unpredictable markets, what specific strategies can retirees use to best reduce the sequence of returns risk, especially in that first 5 to 10 years of retirement?
Yeah, really good question. And it is, yeah, super important. The returns matter the most in your early years of retirement, both because that's typically where your wealth peaks, and because you've done all your saving and now you're getting ready to shift into withdrawal mode. And so if you're pulling money out, so like the really bad example would be you retired in late 2007 or into 2008, and you were starting to pull from your portfolio just as stocks were down 40 to 50%. And so now you have both the withdrawals coming off and the stock market coming down, and the withdrawals aren't there to benefit from the recovery. And that's really what you're trying to guard against. And I think what a lot of it comes back to is, number one, making sure that you have the right asset allocation to begin with. So what's your mix between stocks and bonds, and making sure that you have enough in safe bonds or other safe instruments to weather the storm for as many as call it 5-ish years. And so having enough in bonds to fund your withdrawals, I think that is kind of a good rule of thumb, at least first step, to make sure you have that. So that would be one piece. And then second piece, I think it's also even kind of within the sort of safe aspects of the portfolio, making sure that you have enough in cash or in other short-term instruments to fund kind of your near-term withdrawals. So, that can vary depending upon the client. Different clients have different preferences there, but I think having, call it at least 6-ish months of withdrawals sort of set aside in either cash or very short-term instruments, I think that is advisable as well, so that you have that ready to go if the market does turn down, you have that available. The other thing I would throw out there too to consider, depending upon again the size of your bond portfolio, would be considering a bond ladder. That can be a good step as well potentially. Again, it's not right for every person or every investor, but that could be another thing that could be helpful to guard against that sequence of withdrawal risk.
Yeah, great points, Kevin, particularly, and great question, Clark. Thinking about, when you retire and what are those sequence of returns and how important those are. And now we will go to Rob Fazikis for our next question.
Oh, thanks, Deanne. So as Kevin mentioned during his presentation, we started to see some unmistakable signs of a slowdown in the labor market, but at the same time, inflation is still running a little bit ahead of the Federal Reserve's 2% target. Can you talk a little bit more about how the Federal Reserve might handle this situation when the twin goals of their mandate appear to be in conflict?
Yep, and I think one thing I didn't mention in the prepared remarks, that this is all sort of on a backdrop of the Fed chair is going to be changing next year. So Chair Powell, his term is up in May. It's widely expected that President Trump will nominate the next chair, likely late this year, early next year, and so we'll know who that is. Honestly, probably in a matter of weeks. Right now, if you look at prediction markets, Kevin Hassett is the kind of odds-on favorite, roughly like a 70-ish% chance last time I looked. And there's no doubt that President Trump wants lower rates. I mean, he's said that repeatedly. And so it will be interesting to see how that plays out next year. One thing I've been reminding clients and investors is that Trump can nominate a new chair. He obviously has influence over new nominees that come up, and over time, more and more of the committee will be made up of Trump nominees. Nevertheless, there is still a voting structure in place. So just because Trump wants lower rates, and let's say the chair is even going to go along with it, it does not necessarily mean that that's what will happen. And so that's kind of why I think you're seeing markets basically pricing in just two more cuts next year, which again would mean lower rates, but is probably not like a 1% level, which is sort of what's been bandied about by Trump and others, getting all the way down to sort of where we were in the 2010s. The market is not expecting rates to go down that much, and again, partially because inflation is still running, as I said, north of the 2% target. And so that would be, I think, kind of the market would be sort of where I would take my cues from, in the sense that I think 2%, I'm sorry, 2 rate cuts is a reasonable guess for next year, but I think it will be somewhere in that range if I had to guess.
All right, thank you, Kevin. And our next question will be from Brian Rosso.
Hey, so I mean, Rob mentioned the interest rates. There's been a big emphasis on interest rates, inflation over the last few years. But as we sit here in December of 2025, when we look back, we've had really 3 great years of market returns. So knowing that, and investors are looking into 2026, what should they be taking away? What should they be thinking about, if anything, for in the expectations for 2026 market returns?
Yeah, it's a good question. One I've received a good bit of. So the first thing I'd say, and this kind of harkens back to that slide I showed, showing that investing at all-time highs is just as good or better than investing in any other day. And kind of going along with that, if you look back historically, knowing that the market did really well in one year doesn't really tell you much about what the market's likely to do in the next year. So there's not really a high correlation, no real relationship between those things. What I would say, though, and I mentioned this briefly in the prepared remarks, is that valuations, or the price that you're paying per dollar of earnings right now, are pretty high relative to history, and that is just a fact right now. And so what that has meant historically, again, as I mentioned earlier, has not meant that the market is doomed to crash, but it has meant that forward-looking returns are likely to be lower than what we've experienced here in the recent past. So I would not say forecast out 15% per year returns going forward from here, just because that's what we've sort of lived with over the past 2 or 3 years. I would not anticipate that continuing into the future. The other thing that I would mention on the topic of valuations is that valuations being high relative to history is really only true for U.S. stocks. It's not as true if you look outside of the U.S. to developed international or emerging markets, and it's not even really true if you look at, say, U.S. small cap stocks or U.S. value stocks are not very highly priced relative to history. And so there, again, when I say lower returns in history, I'm talking about over, say, the next 10 years. I don't think you can use valuations to try to time the market, because after all, U.S. stocks were highly valued coming into this year and coming into the year prior to that. It's just that they've now become even more expensive as we've now had another really good year for U.S. stock markets. So I don't think you can use it to time the market, but I do think you can use it for planning purposes as you're trying to forecast out, when can I retire? How much can I spend in retirement? Those types of decisions.
Fantastic. For next question, we'll go to Gary Stoller.
So yeah, this is kind of in the same vein, but I guess just more subjectively, if someone's just thinking about their personal financial planning and they see a great year or period of years, should that change the fundamentals of their planning philosophy? Maybe they weren't planning for these types of gains the past year, and so maybe they have a little bit more assets than they were, expecting. So should that, influence or change their approach for their own planning for the next few years?
So I think it absolutely can. I mean, we tend to be pretty conservative with we don't think we're overly conservative, but tend to be conservative with the capital market assumptions that we bake into our financial planning. And so if you have now a few years where returns are better than what we were anticipating in the planning, that could be a trigger to sort of revisit that, say, hey, I was planning to retire in 2028. Now maybe I can bring that up a year if you would so desire. So I think, yes, that can be, we always want to be reevaluating the planning to make sure that it still fits with the current set of facts and circumstances. Specifically related to the portfolio, though, I think it can be a good time to revisit how much risk you're taking. So if you've reached a point in your life where you don't want your portfolio to be as volatile as it was before, and now it's done really well, and you can now afford to take some chips off the table, I think that could be a good discussion worth having with your advisor. But just to be clear, this is not a call about what we expect stocks to do next year. It's more about an individual investor or client's risk tolerance and how that may have changed or evolved in the sense they might not need to take as much risk as they were previously now that markets have done as well as they have.
Yeah, evaluating that from a personal plan perspective would be the best approach for each individual client there. We've got a few more questions from our team members. So next we will shift to Ben Hall.
Thanks, Deanne. Yeah, so my question goes back to the tax changes that we've seen this year. And given all the tax changes that have happened this year, a lot of experts are expecting to see sort of a boost in tax refunds in the upcoming year. So my question is, do you think this could act like sort of a mini stimulus to the economy, and how might that affect consumer spending and the markets in general?
Yeah, really good question. And the general consensus is yes, because many of the tax credits apply retroactively. The withholdings calculations didn't capture those. And so estimates I've seen are expecting refunds to be about 18% higher than what they were last year, which is a boost to sort of short-term spending power. It likely boosts the consumer in the first and second quarters next year, but of course that's going to be a temporary effect, and it's already priced in by markets. This is not something that just those of us on the call know. It's already kind of well baked into the prices that you see in markets already. So we wouldn't recommend any portfolio changes based on this knowledge, but yes, you should see, at least in terms of the economic forecast, a bit of support to the consumer. Of course, again, cutting against that is a softening labor market. So even if you're getting a big tax refund, if you've lost your job, that doesn't do you all that much good and will not boost consumer spending that much. But holding everything else equal, yes, it would be a boost to consumer spending.
Okay, great. Thank you, Kevin. Next, we'll shift to Preston Wilkie for the next question.
Thanks, Deanne. And thanks, Kevin and Mike, for being with us today. My question is, this year, a lot of headlines are focused on the AI trade and the market concentration in the Mag 7 stocks. Can you explain how much those names actually drove market returns this year?
So yeah, it of course shifts every day, and just so folks know, what's kind of the Mag 7 is essentially Apple, Microsoft, Amazon, Alphabet, which is Google, Meta, which is Facebook, and Nvidia and Tesla. And that's essentially what the Mag 7 stocks are. And they have driven a huge portion of stock market returns, really not just in 2025, but from 2023 through 2025. And they remain a pretty big weight in the S&P 500. And so this isn't the first time that we've seen the market get as concentrated as it is now. It was, I showed again, quickly touched on a brief slide on this in the prepared comments, but back in the late 90s, early 2000s, we kind of had a similar story, even more so by some measures, even more concentrated then than we are now. And so we did see this year market returns kind of broaden out. It wasn't as concentrated in 2025 as it was in 2023 and 2024, but we still think that the risk of market concentration is real, and it argues for diversification of your equity portfolio. So that would mean again, including allocations to smaller companies, more value-oriented companies, and getting exposure outside of the U.S. to developed international and emerging market companies as well. And so we think diversification is kind of the only free lunch in investing, and it will remain a good strategy even if those Mag 7 stocks remain pretty influential over U.S. stock market returns.
Are they around about 35% roughly of the S&P 500?
Yes, yeah, that's about right.
Pretty large percentage there.
Yeah.
All right. And for the last question from our team, we will go to Jose Colmenares. Jose?
Hey, thank you, Kevin and Mike. My question for either of you is, based on the results we've seen this year in 2025, will international developed and emerging markets continue to outperform the US in 2026, or are we due for a reversion?
Yeah, so I got some interesting stats on that one. So over the last 15 years, there have only really been 2 years where internationals outperformed. So one was in 2022, and then most likely here in 2025, international will outperform. Of course, we still got a couple weeks left, but it's looking like that will be the case. And 2025 is really the only, again, by definition, the only time over the last 15 years where international outperformed in an up market. So in 2022, international outperformed, but did it by losing less than what the U.S. did. And so, as I've talked about already, valuations still favor an allocation outside of the U.S. So if you ask me, say over the next 10 years, which is likely to do better, I would say ex-U.S. stocks would be likely to do better. Of course, when I say that, I would say it with sort of like 60% certainty. So it's not much better than a coin flip. If you asked a mechanic for advice like that, you would fire them. You wouldn't want their advice to only work 60% of the time. But that's just kind of the nature of markets, that stock returns are so volatile and so noisy that it's very difficult to say with any certainty what's likely to happen over the next year or over the next 10 years or so. But I think for those of us who have been in these diversified portfolios over the last 10 to 15 years, we can be thankful that it paid off here in 2025. But I think really the best advice is just to own everything. If you're not sure what's likely to outperform going forward, your best bet is just to own everything. And so you have exposure whether the US outperforms or whether ex-US outperforms.
Agreed. And I, for one, and I think everyone on this call is happy to see international outperform this year and to see that make such a positive impact in our client portfolios and our own portfolios. And, finally, what we've waited for all of these years. And so going back to the phrase you used earlier, diversification is your only free lunch. And so take it. And that's all the questions from our team members. So I'll now shift back to Betsy Kenyon. And Betsy, do we have any questions from the audience?
We do have a couple questions. Both Mike and Kevin, thank you both so much for your insights today. We always look forward to hearing what you all have to say. And we do have two questions from our audience. One is, Kevin, could you explain what a bond ladder is?
Sure. So that would be investing in a portfolio of individual bonds or individual bonds that have maturities that are at different points in time. So you might say invest in 5 bonds, one that matures in 2026, then another that matures in 2027, so forth and so on. And that's described as a bond ladder, and it helps balance the different risks that you have in fixed income investing. So if you invested all of your money into a bond that matures 5 years from now, and then rates happen to move up, then that would be bad because you would have been locking in the rates as they are now and not being able to take advantage of rates being higher. Now, on the flip side, if you invested all of your money just in a bond that matures a year from now and rates go down, now you're sort of then reinvesting now at lower rates just a year from now. So by laddering it out, you're kind of diversifying, again, kind of the theme, diversifying your exposure across different maturities. So that's essentially what a bond ladder is. It's an approach to investing in bonds that balances both reinvestment risk and the risk, and it basically balances all the different risks associated with changing interest rates, essentially.
Excellent. Thank you for that explanation. And then our last question is, what is the recommended allocation for someone 80 years old, equities/fixed income?
Yep. And so that's very difficult to know without knowing more about your personal situation, but I can kind of walk you through the framework that I would think about. there. So we would generally say that your asset allocation is a function of your ability, your willingness, and your need to take risk. And so knowing your age, that is really just tells me about your ability to take risk, which is a function of your time horizon, which is between now and your life expectancy. So somebody who is very, very young and has a long time horizon, they can be more invested in stocks than somebody who is older and has a shorter time horizon. So that's just one piece of the formula. It's not everything. The other pieces are how much risk do you need to take, and that is a function of how much are you looking to spend relative to how much you've saved. If you're looking to spend a lot relative to how much you've saved, then you need to take more risk in order to achieve that goal, and vice versa. And then the last piece is your willingness to take risk, which I also call kind of a stomach acid test, which is to what degree are you willing to stick with your portfolio during periods of market volatility? Are you someone who, when the market goes down, you say, hey, I need to get out of stocks now? If so, then you probably shouldn't have much invested in stocks to begin with, because as I described earlier, the whole key to earning stock market returns is sticking with it over the long run, even during periods of market stress. On the flip side, if you're somebody who never pays attention to what's going on with your portfolio, you're just sort of set it and forget it, then you can have more invested in stocks. And really, what I think an advisor's job, and what the folks at Elevate do, is try to blend those three different factors together to come up with what the right asset allocation is for your personal circumstance based on your personal ability, willingness, and need to take risk.
Thank you so much. Deanne, did you want to add anything there from the Elevate perspective?
I was just about to say agreed, and I couldn't have said it better myself. Thank you, Kevin. I think that overall, that is, Kevin hit the nail on the head. That is exactly what we do here at Elevate, is work with individuals and families and small business owners to figure out what are those things that are most important to you? What is it that you want? And then what risk do you need to take in order to, what savings rate do you need? What risk do you need to take in order to meet those goals? And balance that alongside your risk tolerance, and help put you in the best position for success in the long run. So I wanted to say thank you again to Kevin and Mike for joining us today. Kevin or Mike, any final comments on the year-end wrap-up?
So the only thing I would say is, thanks for joining today, and hope everybody has a healthy and happy year-end holiday season, and stay disciplined to your long-run plan. Again, it's the theme of today, but those would be my parting words.
Thank you. Fantastic. Well, thank you, Kevin, again. Thank you, Mike. And thank you to all of our team members for joining us today. And thank you guys for out there for watching. Just so you know, we do these every month. And so feel free to take a look at our website, elevate-wealth.com. You can see our lineup of webinars that we do monthly. We also have a lot of education and content that we put out on our social media platforms. So feel free, again, to navigate over to elevate-wealth.com, and you can find us all of our social media platforms. And we'd love to hear from you too. So if you have any questions, or if there's any way we can be of assistance, feel free to click the button Let's Chat and type in your contact information, and we'll be glad to reach out. Want to echo Kevin's comments and just say thank you all for your trust and confidence in Elevate Wealth. And we hope you have a very happy holiday season and best of success for 2026.